Hello and welcome to the Bullish Bears YouTube channel. I'm Jeremy, and this series is going to be called The Wheel Trade. Essentially, I'm going to go over some quick technical analysis on the charts of a couple of specific equities that I like to wheel trade, and I'll give you a little bit of the how and why, as well as a little bit of, I'll just announce current positions. If you do like what we do here, please feel free to like and subscribe to our channel. And if the information in this series happens to really tickle your fancy and you really appreciate it, feel free to shoot us a super like if you would. Any support for this channel helps us keep our operating costs down for our community, and we really appreciate the support. Thank you very much. Moving on. So my first position, and this is kind of my primary wheel trade position, it generates tremendous premium for what it's worth, and cost outlay per percentage return is an average of about 8% monthly per contract. Natural yield, if I was to just open them and leave the sold to open options running, it would be about 8% per side. So calls and puts combined be about 16% natural yield on this one per dollar outlaid. So what I like to do is I like to sell out of the money cash cover or cash secured puts as well as covered calls. This position I'm long equity, and the idea is to maintain enough capital in your account to acquire twice the position size while maintaining a long position that covers your cash secured puts with cash in your account, as well as a long equity position providing a position to leverage covered calls against. In this one in particular, I like to focus on price action and use that to identify opportunities to sell out of the money strikes for a dollar or more. And typically I focus on the 1 to 2 weeks out expiration on this particular equity. My current position on this bad boy is, let me get into that. I have on January 31st, I sold to open a February 14th expiration 48.50 covered call at $1.05 premium per contract. And on the same day, I sold to open a February 14th 42 strike cash secured put at $1.10 per contract. So I have $2.15 worth of premium open on this. And currently I could buy to close those relatively cheaply, as price is fairly neutral and kind of in the middle of my strike range here. So I'm looking at the 48.50s way up here. They were way out of the money, but I was able to sell those with some pretty good premium on, let's see, where's the 31st? Right in this wick here, right on the open midday range. Pretty easy to set a limit order and get that kind of premium. Um, at the same time, on the same day, when price dipped down, I was able to sell those 42 strikes for a pretty penny as well. So the 42 strikes sit kind of in an area of liquidity down here at the base of the range currently that I wouldn't mind owning more. Even though my current cost basis on current position is in a little bit under the water at 45.06, I still have enough premium on that to not worry about that too much. My position cost basis since I started wheel trading TNA back in March of 2024 is all the way down at $19.92 per share. So I could care about being a little bit underwater with my current position. The goal here is to generate income over a long period of time. Sometimes you got to sweat a little bit. Sometimes you get a little nervous as price comes down through your current cost basis. If you're not into this for very long and you're not rolling these out and generating income, there will be times where your heart will pound and you'll see some serious unrealized losses in your account balance versus these types of positions. But you have to realize that you are focused on the long-term goal of income via options premium rather than share appreciation. Although you will be called away on occasion for your covered calls, that does happen. You gain the share appreciation from your cost basis, and the idea is to sell strikes that are above your cost basis anyway. So you win in that situation, and you get paid to wait to win. On the contrary, to acquire more position and If you are assigned on a cash secured put, add the cost basis of the shares acquired in that to your current position, divide by 2, and you have your average cost basis. And then the idea is if you end up taking possession of shares that are doubling your position size, if you can, if it's equitable, liquidate those shares for whatever you can get for them, hopefully on a price popping back up. And then you can take your share appreciation plus the premium earned on assignment and take that off of your current total cost basis. So there's a little math involved, a little journaling involved, but if you keep track of it, overall, you will eventually own something like this for free. And at one point, you might even own it for a negative cost basis. I have covered half a position size back in October before I acquired another short options position or sell to open puts. For a while there, I waited. Um, Technicality is from March to October, I owned this equity for a negative cost basis of $1.36 per share. When I took another position, that offsets. So I have to add them together, divide by 2, and figure out where it met in the middle. At that point, my running total cost basis on acquisition of that position was 21.78. So I'm not doing too bad. Overall, I plan to own this twice for free eventually, and the idea is I can just continually generate income on this as time goes on. So current daily chart, I'm looking at kind of a potential risk for downside down here to even below $38. That can happen. The object is to not sweat too much. Currently, the liquidity zone I have mapped out on a 2-hour chart is right in play with the current daily 200 moving average. So I'm okay to be in a position there, and plus or minus a little bit isn't going to kill me. I can just acquire more cheaper and keep kicking that can down the road and generate income. So bit of risk involved in this, but if you are patient with time, you will eventually generate enough premium on it to own it for free and keep rolling. Overall, this has been a pretty well performing ETF, even though it's triple leveraged against the Russell. It's got this really big capitalization zone here. Yes, that does broaden the range quite a bit. I have a long-term reversion target if things remain bullish here at about 63.40. That can happen. In the meantime, we've got this beautiful elongated rounding bottom with the uptrend happening now. So I'm pretty confident that this is going to continue to be a lucrative position to be in. This is what you look for. You look for something that's kind of bottomed, whatever it is. And you can do this with equities, you can do it with other ETFs, doesn't matter. When you find that the trend has been sideways and accumulating for quite a while and slowly developing into a slightly bullish trend, that's the ideal time to get involved with a wheel trade because you want to have a slightly bullish outlook on the equity overall over a long time. Look years down the road, not months. All right, so hopefully that helps you out there. I'll introduce you to another position that I am attempting to acquire recently here. Let me get this going really quick. Switch screens here. There we go. NVDX is a 2x long NVIDIA single ETF or single equity leveraged ETF. As you know, I'm pretty good friends with Matthew Tuttle there. He runs this particular exchange traded fund, and I found it to be, now that it's got nice liquidity in the options chain and weekly options, premium is outstanding on this one. Per dollar outlay on this thing per side is upwards of 10%. So if again, letting monthly expiration covered call and cash secured put at the same time out of the money, per outlay of each dollar, it's 10% on the puts, 10% on the calls, roughly. And if I was to just sell those to open and let them run to expire or assignment, they would each yield about that. So that's a potential natural yield, I like to call it, of about 20% a month. That's pretty insane. Like any other leveraged ETF, they tend to depreciate a little bit over time, less the operating fees of the ETF. But NVIDIA is one of those stocks you really want to own anyway. And if you can get 2x leverage on the equity, it makes it more of a day trading vehicle, sure, or a swing trading vehicle, yes. But if you're generating enough premium on it to own it for free, in a very short amount of time, what do you care if it depreciates? You're going to be constantly generating income on this thing. And if you're getting 20% back per dollar natural yield, yeah, it's a no-brainer. It's really worth the premium and really worth the risk, in my opinion. I don't think Nvidia is going to be bankrupt overnight anytime soon. Looking into the range, though, I sold some $10 strike cash secured puts recently, and actually I did it twice. It was so nice. No, no rhyme intended. Entered the first one. I sold to open on January 27th. Sold to open February 7th expiration, $10 cash secured puts at 90 cents. Closed them on the 29th, a couple days later. Bought to close those at 30 cents. That's a net of 60 cents per share off my cost basis without even taking a position. So it's an example of you can buy to close those options contracts if you feel that you're happy with the amount of premium you've captured. Also, at the time, I was pretty intent at seeing this give us a nice double bottom reversal, which it more or less did. We had it right down to the liquidity zone. So on the 31st, when I thought it was at support, and here it was, I sold those $10 strikes again, but I rolled them out to the February 14th expiration and received 90 cents credit for those as well. Currently, I can probably buy those to close at a nickel a piece and roll them out to the next expiration if I wanted to. I might even let those expire worthless and take a long position because I have a reversion target here at about $13.70. I may consider taking a long equity position and selling out of the money covered calls up in the 1350 range to generate some extra income on this right away. Currently, I do not have a long equity position. I've just got the cash secured put rolling out. So I'll keep you posted on that one as time goes on, whether I decide to take a outright long position in the equity around here or if I'm going to wait for another pullback. Will remain to be seen. I'll see what the price action tells me to do. In the meantime, thanks again for watching, and I'll keep you posted week by week. So we'll see you every Friday. I'm going to try and get this out at 2 o'clock every Friday. We'll play it by ear. But I'm going to make this into a regular thing. Thanks again for joining. We'll see you next time. Hello, and welcome to the Bullish Bears YouTube channel. I'm Jeremy, and today I'm going to show you something that's going to take a little bit of work to develop. So put on your blue collar. This is going to feel like work. Mainly, it's not going to break your body, but it's going to really test your head. So I'm often asked by many of our members and sometimes some of my friends, how the heck do you scalp on such a very short time frame? Well, it's actually easier than you think, but harder than it looks. Let's go there. So let's start off by explaining how I process this. So I'm looking at two different time frames to trade another. So I'm looking at a 1 second chart for trading, and I'm looking at a 1 minute chart to see where I'm at within a particular trend. I'm also looking at a 4 minute chart. I have to use seconds on Tradeovate to make this happen. So 240 seconds, 4 minutes. So one of the things you would do, and you can do this with a 5 minute chart, it doesn't matter. You can try to use something in a multiple is what I'm getting at. So I'm looking at building what's called a standard deviation channel tool that relates to linear regression of a given time frame or a given count of candles that it's looking at. And then it gives standard deviations in any interval you would like. In this case, you have to lay down 3 of them to get all of these bands that you would like to see in this. The idea is use a look back of 240, which is going to give me 4 minutes in the 1 second chart. All that is 4 minutes. And effectively, it's also going to lay into multiples. So laying into a 240 look back on seconds, it's going to give me 4 minutes as well, but it's going to give me part of the trend that I like to trade. And what I'm seeing here is a nice rounding top with a couple of range extensions within this trend. The trend is slightly bearish for the moment, but I'm not going to trade any particular bias. I just want to trade the little incremental moves on the 1 second chart. But I do need to keep paying attention to what this 4 minute chart is telling me. I need to know what kind of range to expect. And I also need to know what kind of range to expect on a smaller scale in the 1 minute chart here. 240 doesn't quite jive into the 1 minute, but it's close enough to where you can see exactly what's going on in a 1 minute space. So the hard part, this is where it's going to take a lot of head work, but it's going to look easy. So if I'm looking to scalp a move and I'm using a linear regression line to spot my center of gravity within a 1 second time frame, I'm going to count each of these intervals in halves. So I'm going to go 0.5, 1, 1.5, 2, 2.5, and 3. And as you can see, we get that kind of range. The idea for this is that you want to scalp the moves that are secondary. So you want to spot the moves that are primary and scalp the moves that are secondary. So if I have a primary move that goes from linear regression down to whatever extreme it may be, sometimes it's only 1, sometimes it's 1.5, 2, depends on how many standard deviations from linear regression that it trades. But typically, once price crosses back through linear regression, it is very likely to make an equal move on the opposite side of linear regression. So if I'm trading a 1 standard move, I'm trading from linear regression to 1 standard above after seeing a move that was 1 standard below, and so on and so on, 1.5, 2, whatever it throws at you. Also, you need to know what the general trend is doing. So if you're going to pick a direction that you want to scalp, you have to know if you're generally bullish or generally bearish within that time frame. So in this case, we're looking generally bullish, and I'm seeing that the 1 minute chart is telling me we've had a 1 standard deviation below linear regression move here. We accumulated at linear regression. We bounced it again, hit 1, bounced it again, hit 1, and now we're consolidating in the upper range. So more than likely, if I'm going to scalp this, is going to be very short-lived and a bullish move. Looking at the 5 minute or 4 minute, sorry, I can see there's a primary and secondary move here that exceeded its own width. Well, mostly. If you look here, you can see there's 2 standards here and 2 standards here. Sorry, this might be hard to read on a smaller screen, so I'm going to try and blow it up as big as I can. So getting into this kind of move here can be a little tricky on the 4 minute scale, but if you look at things, they tend to react pretty well with this in scale. A while back, I showed people how to draw and trade fan lines in a very similar fashion. You're looking for primary moves and you want to focus your trading on a secondary move. So if you see a primary move, typically you get a half back, and then in this case, you got a revisit of that high, and then it made another extension move. Well, in a 5 second chart, that can be hard to read, but in a 1 second chart, it's actually easier. Oh, of course, my dogs are barking. Let's see if I can get that in post edit. All right, let's get to the brass tacks here. Quick reversion trade, probably right off of 2 standards, and we're looking for a return to linear regression here. If it doesn't fill, I can probably move it up a little bit. We'll go to 1.5. Missed me by a tick. That's going to happen a lot. Like I said, put your blue collar on. It's going to take some work. All right. My expected move is returning to linear regression from here. I call my dogs my hmm, risk management team. They seem to bark to get my attention when something's about to happen, pretty typically. Bam, target met. And even if it runs away, I don't have to care. I'm using the ME or the MNQ to make examples here because if I showed this with full-size contracts, people might get a little odd about that. Sometimes I do. I made a whopping $6.50 there. But in the scale of full contracts, that would have been a $65 bill right there. Bam, just that fast. Lo and behold, two standard move. So it went beyond my expectations. And now we're going to probably catch half back, which is going to go right to linear regression. Bam, just like that. So when you're looking to trade a secondary move after spotting a primary move, you can do this in many different market conditions. However, when you have some opening range volatility, and it's about 5 minutes before the bell here, you're going to find that it's very, very difficult to stay in tune on a 1 second chart in that kind of volatility. You're going to have to really do some head work to examine that 4 minute and 1 minute time space well enough to be accurate on your trades. It can really get out of hand. So ideally, if you're going to learn how to do this, stick to a time of the market where volatility is typically low, and it's usually kind of right in that space between 8:30 and 9:30 is typically where I'll trade before I go and start doing my live streams. Um, During the opening hour or so, I'm often scalping on a longer time frame. I'll use a 5 second, or sometimes I'll just scalp the 1 minute chart and run that. When things settle down around 11 o'clock or so, if I still want to trade, that's ideal for this 1 second chart time frame because the market is typically going to have low volatility, but you're going to notice that most of the moves you see are kind of what are perceived as algo trades where there's just a couple robots moving things back and forth to provide liquidity in the market, really. And the more influence they have on price action, the easier these secondary moves are going to be um, visible to you. You're going to see them much more regularly when price movement is slow or when market participation is low. So pre-market times, you'll get a lot of that. Um, Middle of the day times, you'll get a lot of that. Sometimes you'll have a slow moving morning where there's just no news moving things or what have you. That can get to be pretty mellow, but you really got to focus on paying attention to what is happening in the world. You can use a news outlet or something like that, or especially with Trump in office, you're going to have a lot of tweets that can just really make some fast, seemingly, uh, knee-jerk moves in the market. That's going to make things pretty difficult to use this method. So ideally, if you're just learning it, focus on really calm times in the market where there's just not much expectation of participation or knee-jerk reactions or news events or anything like that. It's hard to predict when the man's going to pick up his phone and drop a tweet or say something about a tariff or something. Those affect the market very genuinely and very rapidly. So you want to be very aware of that. Anyway, just thought I'd give you a quick demonstration on how that works and a quick explanation of what I'm looking for. I could have been trading this entire channel here in this time space. And although your little base hits will be small, um, they add up. Yeah, you'll be eating some commissions on that for your trading fees and what have you. But if you get in practice with this, it actually helps you to recognize price action on every time frame. This will give you a very fast, repetitive way to learn price action. This kind of accelerates your seat time, if you will. You spend enough time scalping this stuff, and you can glance at any time frame chart and recognize what you're looking for. And what you're looking for is secondary moves or reactive moves. And I'll tell you, they happen on every time frame even on a monthly chart, you'll see them. Get enough screen time doing this, even if you're just doing it on paper for the process or learning how to recognize price action rapidly, you will be greatly benefited by doing this, at least as a practice. Um, Before long, you will feel your head hurt. It will really take its toll on your brain function. So don't do this all day. Do it just a little bit at a time. You don't have to always be looking for trades. Sometimes it's good to take a little break and let yourself develop some calmness in your cognitive abilities so that you can actually function in this manner without burning yourself out. So give yourself a little break every now and then, and you'll get this. It'll happen. Here we're watching the market open, and we can see some great volatility. This would be very difficult to trade on a 1 second level. I don't even attempt it. This I can do on a 1 minute chart or 5 minute chart, whatever. That's fine. But doing this on a 1 second, you're going to have a hard time tracing these moves out. I can go and use it for calling out price targets pretty well. I can trade it myself sometimes. Depends on conditions, and a lot of those conditions depend on how good I'm feeling that day. But oftentimes I can spot these moves pretty quickly. So you can see a primary move here, accumulation. Secondary move was about equal. And when I'm calling out price targets on the fly, that's how I'm getting them. I'm finding the primary move and estimating the secondary move using the primary move. Here we're having a 2-for-1 move here. So we have 1, 2, 3 total impulses. There's the primary, there's a secondary, and there's another one. Now we're getting a move back to support here. So when I'm calling out price targets on the fly, it's exactly how I'm doing it. I can find these really readily. When you've had enough seat time watching for that secondary move, it just becomes second nature. You don't even need any indicators on your chart. You can just use candles and say, hey, this is going to 22, 138. Bam, easy move. Or after this primary move, you can say, this is going to 22, 124. So your scalp is, going to be about, in that case, 10 points. But hey, 10 points makes some pretty decent money, especially when you're using full-size contracts. Anyway, I think I'm going to leave with that. I'll see you guys in the next video, and stay tuned. I'm going to give you some more advanced stuff as time goes on. And I'm being hounded to generate a video using TPO and another strategy that I use in concert, and that's coming. Stay tuned.